If you have not like and subscribe, please do like and subscribe. Also click that bell button so you get all the updates. And let's get started. So today's topic is basically why most people lose in trading. So most people lose in trading. In fact, if you look at the data, 72 to 80% of the traders lose money. And I think in option it's probably even more. Most people are losing money, but it's kind of addicting, right? So you lose it, you want to kind of revenge trade, you want to make up for it. So if you are losing money, this is for you. If you are making great money, 30-40%, 50%, probably you can still get something out of it. But you are in pretty decent, right? So we're going to talk about why most people lose money, how to mitigate that, and kind of talk about the ETF and whatnot. So one of the reason is one of the reason most people lose, one of the most important reason I think is risk management, right? Portion sizing. So risk management, there's a lot of, one thing is obviously like number one I think is portion sizing. So if you have an account, whatever it is, whether it's a 500 or 1000 or even like 50,000, right? A lot of people, what they're doing is like they literally made from 1 to 2k, 2k to 10k or whatever, and they get like kind of cocky, they get overconfident that they'll put everything in one single stock or one single option contracts or whatever it is, right? Again, you can make a big money in that if everything's works in your favor, but believe me, like if you keep doing that, on the long run it will work against you and you lose all. So it's not good. So always, I think number one thing is position sizing. You should never with the bigger account, it's a lot easier to make the size smaller. For example, if you have 100,000 account, you can make 1 or 2%. So basically your one play will be uh, 1,000 $2,000. Whether if you have a smaller account, let's say 1,000, it becomes harder. So probably you need like a couple hundred, so you may go up to 20, but I would suggest never go above 20%. That's for both stock, options or anything, right? Option even dangerous, so it's better to have a smaller position sizing. Other thing is, a lot of people are trying to flip money by if you are in options, most people are in option, of course. If you are my viewer, uh, they are trying to flip and getting weekly calls. Weekly is a really risky, really dangerous. You will lose mostly than winning unless you know exactly what you are doing, which a lot of people don't know. So weekly is a bad idea. Get a few weeks out, right? 2-3 weeks out, even months, right? Leaps are great. You have a time in your favor, so that will work. So other thing is like, don't look at the smaller short term, right? Short terms stock. So if you short term, nobody knows where the stock is going. It can go up, it can go down. Literally, you can do a coin toss. It may the probability of going up or down is 50-50. This has been analyzed so many times. And even if you look at the ticker, right, this is weekly, but if you look at that, pretty much, I mean, from what I see, there's of course a little bit more green, but when's red is basically it's random, right? You have a one red day, two red day, then two green, then red, two red, then one green, then three green, then big red, 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 right? So in the short term, you cannot predict where the stock is going. It's really hard. You can have a great news, it may dump. It can have a great news and it can kind of up, but still you have a catalyst you can do. But in short terms, you cannot control. Maybe there could be, for example, the March crash. We had the COVID news before it. I mean, the stock market did not care about that. As soon as I mean, as soon as lockdown kind of those things came up, it just dumped like anything, right? It literally kind of the fell from heaven. I mean, 1 2 3 4, like, literally in like 4 weeks, it was down like 20-30%. That's a big drop, right? So what happens is a lot of people get in right here and they see this drop and they get out and they will just like, investing is not for me and I will never invest, right? That's but if you look at the longer term, if you bought it even here and if you hold it, you are literally right, 220 to almost 300, almost what, that's like 20-30% up. So I need to calculate, but significantly up, right? Almost 30%, right? Even if you got the top before the crash. So if you got it here, that's awesome, right? You are perfectly bottom. So if you look at the long picture, these are just the slight bumps in their it happens, nobody can predict. So if you are looking for 5 years, 10 years, this blips doesn't matter, right? We had that here, we had that here, we had that here smaller. This was quite big, this was quite big, right? So there was one here. Kind of we are in this range. But if you look at the long term, stocks kind of from literally from 16 going up, and even if you can even go to 5 years, that's even all time. We had this is I guess tech bubble 2001, which took quite a long time actually. It almost from the top, it took almost 16th year. Wow, yeah, that's quite interesting. That was pretty beaten down, but again, that's why you keep adding it, right? You keep adding every month in ETF. Like, so ETF is a great way to buy. The problem is when you're trying to pick one stock, it's really hard which gonna do good. I mean, we can have our thesis, but anything can go wrong, and it's really hard to predict in the short term. But if you are in ETF, you are not betting against one company. So basically, if you have SPY, you are betting within for America. So unless America go down, which I highly doubt it, you will be always coming ahead, right? So don't worry about short term, long term. So ETFs are great. There's a lot of ETFs. I'll probably make a whole video on ETF. You can kind of talk about ETF. Pretty much you can get ETF in every sector, right? QQQ is for tech. You can have the SPY, which is overall. IWM, which is for small cap stocks. You can have XLF. You can have energy. You can have EV ETF, you can have biotech ETF, you can have ETF just on the FANG company like top 10 FANG, you can have ETF on oil company, you have energy, you can have, you literally, I think there's literally 5,000 to 6,000 ETF. So you can pretty much, and there's a lot of leverage ETF are not for investment. So so I think like most of the people, if you are losing money, ETF is a great, at least you should have like 50-60% in ETF. Don't worry about it. But mostly kind of ETF like SPY and QQQ, mostly they're concentrated. After that, I guess maybe 20-30% you can maybe put a little bit on kind of sectors like maybe EV sector ETF. If you put in EV sector ETF, you are not betting against one company, right? So even if it's like a Neo does great and Tesla fails and all other companies fail, you still be in that sector. But while if you just bet on one company, Neo or something, what if happens something same thing like LK Luckin Coffee, right? They went bankrupt, or Hertz, right? So Hertz, car rental company, like hopefully all car company won't bankrupt, right? If you have all car overall, you'd be fine. But if you just put everything in Hertz, it can kind of work against you. So always diversifying is key, and most of the people's ETF work perfectly. You don't need to worry about that, right? So and uh, what I want, and also always have some cash, right? Like 20-30% have cash. So when you have this big blips, you have some money to get in, right? If you are fully vested and you lose value, you are literally down. But if you vested, like whether it's stock or options, if you have like some cash in your portfolio, it will help you during this kind of blips. You can buy back, so that's always good. Also, there's so many studies done. Kind of people try to time the market. So timing the market is really hard. One would say you would get right in here, but nobody knew it could have gone this way, right? If you got in, right? So timing. So literally, I think J.P. Morgan Chase or Goldman Sachs, they did a study where basically somebody kind of sold it at this point, and they kind of got in around some point. They kind of missed. There was some study. So if you do that, literally you lost on so much opportunity. So timing, don't try to time the market if you are for a long haul. Just a dollar cost average, keep adding it incrementally. If you kind of look into, I have this one. So this is a QQQ, and if you look at the QQQ 10-year gave almost 19.5, almost 20%. NAV return was 20%, so probably higher. This was 1031 when it was a little bit down, so almost 20%. So 10 years ago, if you literally started with $10,000 and put it 500 every month, 500 every month, which is not huge for a lot of people's, could be huge for some people's, but if you're making like even if your take home is 3,000, you are single, I think this should be doable. If you're not, unless you're in California, well, probably a lot expensive, but maybe then you probably need to figure out how to make increase your income. But if you could do that, right, and in 10 years, and I put estimated rate of return 19, and with the compounded annually, you're looking at 205,000. That's pretty good money, right? You started with 10,000 and you put 500, not a whole lot of money. And if you look at what your total contribution was, it was just 70,000. So almost 300 times. Again, it's a 10 years, but 300 times, that's a good money. And if you look at that, in the initial, its kind of growth is kind of slow, but as you go, it just grows. And if you look at this graph, it will grow more rapidly. So if you increase this 10 years to, like, let's say 30 years, I think you'll be sitting on, oh wow, you're sitting at $7 million, right? Doesn't seems like a huge amount, but look at this graph. As you go up, it's a power of compounding. You have more and more and more money, and look at that. You literally you contributed only 190,000 actually. Look at that. You literally contributed only 190,000, but you made cool $7.6 million in 30 years. So if you're in like 20s or even 30s, right? If you're in 20s and 30s, do you want to retire with like a couple of $1 million? The best way literally is just saving every month, like four. Doesn't have to start 500. You can start with 50 or even 100, right? Put some money, put small amount of money every month. That's all. It's all about the long run. It's not about get quick, like you have to think long term. Yeah. uh, Pretty much, yeah, those are the things I just wanted to cover in this video mostly. And a lot of option traders, don't get weekly, get some time. Don't get like, a lot of people are like, let's say if you are even trading QQQ, uh, don't get ridiculous amount, I mean ridiculous option with the strike price. For example, a lot of people, I see it's 300, they are getting like 350 or 400 weekly. That's basically throwing your money. There's like literally 0.001% of getting it. That, I mean, I'm not saying it's gonna go there, but not in a week. It may take few months or even a year, right? So long term it will. That's why weekly, make it sure realistic. Look at the, like, how it moves, right? Where does it moves in a week? If you look at 1 2 3 4 5, usually it moves from literally 70 to somewhere around like 76 80. So usually $10 range, right? So usually try to get that. Don't get like the crazy. If you do that, I think long run you will basically gonna lose. Yeah. Those were the few of the tips I have. If you have more, I will definitely make video on it, but I just wanted to make some. Thank you. If you have any question or comment, let me know. Thanks.